Hi, everybody. This is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, June 13th, 2026. Hey, I hope you're doing well. I hope you had a good trading week, and hope you are having a nice weekend. I appreciate you coming to my weekend review podcast. I hope it's going to be helpful for you and that you're going to learn something. Last week, interesting week. The market, of course, early part of the week moving down. Towards the end of the week, we had quite a big rally, so I hope you were able to have some of your positions go up and take advantage of that rally. So, interesting time in the markets for sure, and things look pretty bleak at the beginning, and having this rally definitely helpful towards the end of the week. So, the format for today's podcast is, first of all, we're going to run the U.S. legal disclaimer. Secondly, we're going to come back. We're going to take a look at all the positions that I'm in. We're going to take a look at all the trades that I made. We're going to talk about when I entered the trades, why I entered the trade, what the setup was, what the confluences were, how I position size based on the current market volatility, how I am going to place my emergency stop, how I'm going to place my end of day stop, how I'm going to take partial profits if the market gives them to me each day, uh, how I'm going to get into trailing stop mode and what that means, and then ultimately how I am going to exit the position either to the upside if we get to extreme overbought levels, or if I took a loss on the trade, how I had to exit. So hopefully it'll give you a good idea of how I look at trading, how I structure my trades, how I set everything up for hopefully to have a good risk to reward ratio, so that if I'm wrong, and I'm wrong a lot, I can be wrong small. And if I'm right, I have the possibility for some outsized gains. So talk about when I entered, why I entered, and really most importantly, how I am going to manage the positions going forward. After that, we're going to spend a few minutes talk about trader psychology. Really, the most important skill in trading is the ability to follow your trading plan. There are a lot of trading plans out there. Whether you learn them from me or from someone else, you can have the best trading plan in the world, but if you don't follow it, what's the use of it? It doesn't do you any good. So, I've been trading for over 30 years, and every day that I trade, it is reinforced to me for my trading and my students trading and other traders that I know, that really the way to make money in the long run is having a good trading process, but most importantly to follow it. So spend a few minutes on trading psychology. Hopefully you'll learn something. Hopefully something will be of value to you there. After that, last night I went down my master watch list. I always go down through my master watch list every Friday night, one by one, and I look for potential trades for next week. Now, they're not where they need to be yet, but they are getting close to coming into some important support levels. And, I'm a big fan and a big proponent of waiting to enter a trade where you have a combination or a confluence of levels that are being rejected. These can be major moving averages, they can be order blocks, they can be RSI levels, and ideally, all of these coming together. And so I have a list of 9 potentials that I'm looking for next week. Like I said, they're not there yet, but they're getting close. They're within striking distance, and I'll be following those next week. And if one of those triggers, if one of those fires off a signal of a rejection of one or more of these key levels, then I will uh, potentially take the trade. So hopefully that will give you an idea of kind of how I set things up on the weekends and what I'm waiting for next week. All right, so that's pretty much what we're going to do today. And like I said, I hope you're going to find it helpful. If you do, I really would appreciate it if you could hit the thumbs up button. Really helps out the channel a lot. It lets YouTube know that there's some valuable content. All right, well, I'll tell you what, let's start with the U.S. legal disclaimer, get that out of the way, and then we'll get rolling. So hang tight. Thank you.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right, well, let's get started. So let's start here. This is CCL. This is Carnival Cruise Line. This has been a very good trade. I entered the trade here on the 19th of May at 23.88. You can see it's been a really good trade. So let's talk about why I entered this trade. So let me bring your attention to this green box. This green box is an important box for me. Probably 90% of my trades involved this box. And what is this box? This box is called an order block, or I like to call it a smart money area. So yeah, entered here, but let me explain to you what this order block is and why I used it. So let's go back in the past here to 3:30:26. Okay, this is the beginning of the order block. So what's an order block? Well, in order to have an order block, you first need to have 4 things happen. Not difficult, but you need to have 4 things happen in order to define an order block. So the first thing we need to happen is we need to find ourselves a swing low. This is a swing low. A swing low is simply a low that has a higher low to the left and a higher low to the right. So this qualifies: higher low to the left, higher low to the right. Second thing we need to find is after the first swing low, we need to find a swing high. And a swing high is just the opposite of a swing low. It has a lower high to the left and a lower high to the right. So now we have 2 of 4. We do have a swing low followed by a swing high. The next swing we need to find is another swing low that's lower than the first swing low. Well, here you go. This is a swing low, higher low to the left, higher low to the right, and this swing low is lower than this swing low. So let's review. We have a swing low followed by a swing high followed by a lower swing low. So now when you have those 3 in place, we need to refer back to the first swing high. And in the future, if the market goes above that first swing high, we have changed market structure to the upside. So a swing low followed by a swing high followed by a lower swing low, and then this bar here on the 1st of April takes out that first swing high. Now we have changed market structure to the upside, and on this day I have now defined my order block. Now this is the way I use order blocks. People use different ways, different approaches, but I always like to make things simple, and this works very well for me. So this is how I use and how I teach order blocks. But I do understand people have different rules, but this is how I use it. So swing low, swing high, lower swing low. This bar here takes out that first swing high, and as soon as it does that, I know now that the lowest closing bar prior to the market structure change is my order block, the high and the low of this bar. And so as soon as we take out that first swing high, I highlight the high and the low of this bar, and I bring it into the future. Now, let's refer up to here, 417. All right, here we're close to $30. So when in the future now, when you're at $30 and you look back to this order block, is it fair to say that smart money was buying here when it got to here? And I would say 100% yes. I think it's very clear that once you're up here at $30 and you look back here, $24, this was a smart money area. All right. So what I'm looking for is if we agree on the fact that this was a smart money area based upon where it went, I'm waiting for a pullback again to the smart money area. And if it pulls back to the smart money area, it doesn't necessarily mean just because it was smart money area at one point that it has to be smart money area the second time. But more times than not, it is. All right. And so that allows me to buy in these areas. Doesn't always work, but it works a lot more than it doesn't. All right. So swing low, swing high, lower swing low, market structure change. Soon as the market structure change, I can define the order block, the high and the low of the lowest closing bar prior to market structure change. Bring this into the future. So now I am waiting for the price to come back into this smart money area to see, hey, is it smart money again? Well, we're going to find out. Okay, so let's go here to my entry. So my entry was on 519 at 2388. Okay, so why? Yes, you can see we got into the order block, but we got into the order block here also. Why didn't I buy here? Well, there's several different ways to enter a trade based upon an order block. And yes, a rejection of the high of the order block and a rejection of the high of the order block just means it came into the order block and closed back outside of the top of the order block like it did here. Yeah, for sure. That is a legitimate entry for an order block. It's my least favorite because the risk to reward is the worst. I took the trade here on the 19th because during the day, we poked our head below the order block and then we closed back in the order block. This is called a rejection of the bottom of the order block. So you can have a rejection at the top of the order block. You can have a rejection at the bottom of the order block. You can also take the trade if there's a major moving average inside the order block or some other level that I can set. And I set custom levels as well. But for this particular trade, let me find my calculator here. Okay. But for this particular trade, I entered this because we had a rejection of the order block. So, okay, so that's why I took the trade, 2388. Now, the first thing you need to do that I needed to do when I entered this trade is obviously how many shares am I going to buy? And really, everybody, this is probably the most important part of your trade. Because if I buy too much, okay, yeah, it's a legitimate trade, but if I do buy too many shares, if I'm wrong, I can really get hurt. If I don't buy enough shares, okay, maybe I make a little money, but it's not substantial, right? Like I don't even care. So the first thing is I have to buy the right amount of shares. And I use a very simple formula. I've been using this formula for over 30 years. And this is what I'm going to share with you now. So whenever I have a trade, I always use the same formula. First thing I need to know is how many shares do I, or I'm sorry, how much money do I have in my account? Okay, let's just say I have $100,000 in my account. I take 1% of that. You've heard this before. You know, it's pretty standard. Some people use 2%, some people use 3%. I prefer 1%. Some people use a half a percent, but I use 1%. So how much money do I have in my account? $100,000 times 1% is $1,000. If you have 200,000, 1% is a $2,000. So what I'm looking for here is what is my maximum allowed loss on this trade? If it's the worst trade ever and goes against me, how much am I willing to lose on the trade? And for me, 1% is the key. And if I lose 1% of my account, it doesn't happen very often, but if I lose 1% of my account, yeah, it's no fun. It's a bummer, but you can recover from that. Okay. So 1% of my account, $100,000, 1% is $1,000. Now what I do is I refer over to the 2 ATR, the average true range times 2. And this is how I measure the volatility of the market. If this number, and what I'm going to do is I'm going to take that maximum allowed loss of $1,000 and I'm going to divide it by this number on the day that I take the trade, divided by 2.42. It's telling me that based upon how much money in my account and what my maximum allowed loss is, and divided by the volatility, tells me to buy 413 shares. Now, if the volatility was much higher, this number would be higher, and therefore my amount of shares I'm going to buy is going to be smaller. If the volatility is not high and this number is lower, and I divide it into my maximum allowed loss of $1,000, I'm going to buy more shares. So it automatically adjusts for you. If the volatility is higher, it's going to make you buy fewer shares, which is the correct thing. If it's lower, you're going to buy more shares. Okay, so that's exactly what I do. It's very simple, but it takes a lot. There's a lot going under the hood there, volatility and how much I'm willing to lose. So 413 shares. All right, fine. I buy my 413 shares here, which I did at 23.88. Now, the next thing I need to do is I need to take my entry price and minus whatever the value of the 2 ATR was. And I need to minus it. So I entered here 23.88, look to my 2 ATR value, minus that from the share price, and I put a line down here. This is my emergency stop. So if I have 413 shares and it goes down $2.42 to my emergency stop, how much have I lost? The $1,000 that I said I was okay to lose, the 1% of my account. So the good news is that this only happens about 5% of the time. Yes, it happens for sure, but very infrequently, okay? Because I use two stops. Emergency stop, if it gets there, I lose 1% of my account. But the other 95% of the time, if I have a losing trade, it will be because my end of bar stop hit, and it's always going to be much closer than my emergency stop. Well, my end of bar stop on this particular trade would simply in the future be a close below this order block, below the green box. Even if it closed below 1 penny below, I'm going to get out because it closed below my end of bar stop. And 95% of the time, if I have a loss, it's going to be because my end of bar stop hit, not because of my emergency stop. So this is a very good risk to reward ratio, right? A good risk to reward ratio just simply means that you entered very close to your stop. And if your stop hits, yeah, okay, maybe I have a very, very small loss, but it's nothing like my emergency stop. So that's why I always try to enter as close to where my end of bar stop is as possible. Okay, so we had the order block from the past. We rejected the bottom of the order block. I entered 23.88. I position size based upon the volatility. I placed my emergency stop 2 ATRs below my end of bar stop, simply a close below the order block. The next thing I do after I enter and I've placed my emergency stop, end of bar stop, I need to refer back to the 1.5 ATR. And so right now, the 1.5 ATR is 181. Now I take my entry price plus the value of the 1.5 ATR, and I place an orange line above. This is my trailing stop mode. So you've heard in trading that if you enter a trade and it starts to move your way, you want to tighten up your stops. And that is 100% true. That is correct trading. So for me, the level is 1.5 ATRs above my entry. So entered here 23.88. I added to the entry price whatever the value of the 1.5 ATR was, and I placed it above. Now, as the trade progresses, if it gets to my 1.5 ATR trailing stop level, in other words, the orange line, now I go into trailing stop mode. So once I enter it, it doesn't mean I do anything or take any action. It just means now that it's extended to that 1.5 ATR, now all that means is in the future, if I have a close below a previous bar's low, I'm going to exit half of the remaining shares that I have. Now, some people, when they have their trailing stop, they move their stops up. I leave the stops where they are. But if I go into trailing stop mode and then I have a close below previous bar's low, this has the same effect of moving the stops up because I'm reducing the position size by half. All right. Okay. So Rejection of the bottom of the order block is the entry. I position size based upon the volatility. I place my end of bar stop. My emergency stop, my end of bar stop. I place my trailing stop level 1.5 ATRs above. Perfect. Now, everything I've described to you so far, as far as the emergency stop, end of bar stop, going into trailing stop mode, these are all defensive moves. Or in other words, if the price action moves against me, I need to take some kind of action, but it's a defensive action. Well, that's fine, but I also want to play offense in my trading, not just defense. And the way that I do this is I take partial profits each day if it moves a certain distance from the previous bar's close. And so I don't sell it all, but I sell a portion. So with this approach, I'm selling into strength. That's the offensive part of this. So I'm currently in this trade. Let me show you exactly what I'm going to do for Monday. It's very simple. I take my closing price. Right now, the closing price is $29.18. And I refer to the value of the 0.45 ATR. This value today at this moment is 54 cents. I simply take the closing price plus 54 cents, and that gives me my first profit target for Monday, 29.72. So I'll put a line here, 29.72. That is my first profit target for Monday. Now, I always place 3 profit targets every day. So I showed you how to get the first one, closing price plus the value of the 0.45 ATR, 54 cents is 29.72. Now, all I do is I take the first profit target, 29.72, and I add the 0.45 to it again. My second profit target for Monday is $30.26. And now I'm going to place one more. I take the second profit target, $30.26. Again, add the 0.54 to it. And my third profit target for Monday is $30.80. All right, those are my 3 profit targets for Monday. Now, the question is, how much do if I hit these profit targets, how much do I get out of them? Very simple. 10% of however many shares I go into the day with. If I go into the day with 40 shares, I'm going to put a limit order to sell 10% of 40, which is 4 here, 4 here, and 4 here. Now, if the market goes down the next day, I don't hit any profit targets. Then I'm going to have to redo the numbers for the next day based upon the new closing price. But I've been using this for 30 years, everybody, and it's hugely important to me. I think it's very important that you also play offense in your trading. If you start hitting these profit targets, you're starting to lock in profit, which is great. Those add up over time. You're also reducing your position size, which has the effect of, if you reduce your position size into strength, now you have fewer and fewer shares. The fewer shares you have, the less stressful the trade is. The less stressful the trade is, the more likely you are to follow your processes. There's lots of advantages to doing this. Just like in sports, you need to play offense, you need to play defense. In trading, I need to play offense, defense. The defense is my emergency stop, end of bar stop, going into trailing stop mode. The offense is selling into strength. All right, so hope that makes sense. Okay, so those are the basics of the trade. Going forward, I won't be as detailed, but now let's just follow the trade, see how we did. Again, entered here, 19th of May, 2388. Rejection of the bottom of the order block. I position size, I place my emergency stop 2 ATRs below, worst case scenario, end of bar stop, close below the bottom of the order block. I place my trailing stop level 1.5 ATRs above, and off we go. Next day, opened up a little, went down, now it went below the order block. Did I get out? No, because I wait for the end of the day to make my buying and selling decisions. The end of the day price, in my opinion, is the most important price of the day. That's when the large financial institutions start coming into the market. They're dealing with very smart people. They're dealing with the most money, best information, best technology. I want to follow what they are doing at the end of the day. The only exception to that is the emergency stop. If the emergency stop is hit, I get out, doesn't matter what time of the day, I get out immediately because if that happens, I have lost 1%, and that's all I'm going to lose. So I can't wait until the end of the day. But barring that happening, my end of bar stops are based upon the end of the day. Okay, so the next day after entering with the rejection at the bottom of the order block, we had a huge move up. Very nice. I hit multiple profit targets into that strength. And on that particular day, we also got to trailing stop mode. Doesn't mean I do anything. It just means now in the future, if I have a close below previous bar's low, I'm going to exit half of the remaining shares that I have at that moment. Okay, next day up a little, not enough for a profit target. Next day down a little, but we did not close below the previous bar's low. Next day we move up. I sold some shares into that strength. Next day up again strongly, sold shares into that strength. Next day didn't do much. Next day didn't do much. Next day we have our first close below previous bar's low. After reaching trailing stop level, what do? I sold half of the remaining shares that I had for a gain of 13.05%. Pretty nice, right? Took half of the remaining shares that I have, which is a nice feeling, everybody, because now you've sold half. That has the effect of moving all your stops up, and you can just kind of ride this one out. Then for the next 4 or 5 days, we basically just moved sideways, didn't do much. Here on the 9th, moved up nicely, hit a profit target into that strength. Next day down big. Next day up huge, multiple profit targets. And again, on Friday, we moved up and I hit 2 profit targets. So the remaining shares that I have on this particular trade, doing very well, up 18.13%. And the real takeaway here, everybody, is look at the risk to reward ratio. When I entered very close to my end of bar stop. The next day, had it closed under, I would have gotten out, maybe lost a 1/4%, maybe a half at most. So I was, risking little to potentially have a nice big up trade, which I did, which very grateful for that. So right now we are at a 60.52 RSI level. So once I get to a 65 RSI level, now I have some other rules that are going to come into place because I don't want to give all this profit back, right? So if we get near the 70 RSI levels, I have rules there to exit the position or all the position. Specifically, the 5 EMA right here, it's not coming into play yet. I have to get to a 65 RSI. But if I get to a 65 RSI, then I close below this 5 EMA. That's just the end of the trade. All right. So it's great to have up moves, but you need to have rules in place so that you don't give it all back. So anyway, really nice trade. A great example of a really good risk to reward ratio in an order block, and the remaining shares up 18.13%. All right, Lockheed Martin, it's been a nice trade. Now you can see there is an order block involved. It's a very large order block, the green box. I entered here on the 11th of May at $509. So why did I enter this? I didn't take it because we rejected the high of the order block. I didn't take it because we rejected the low of the order block. But I took it because you see this purple line here? This purple line is a 250-day moving average. So, the major moving averages like the 200-day moving average, the 250-day moving average, the 300-day moving average, these are legitimate signals to enter a trade based upon. These are deep dip buy signals. When I teach deep dip buy, they are based upon 300s, 250s, and 200s. Well, this on the day that I took this trade, this is a valid signal. It's a close under the 250 and the close over the 250. So by itself, that's a legitimate deep dip buy signal. But as I was telling you earlier, one of my favorite trades is when we have a rejection of a major moving average when it's inside an order block. So clearly, this moving average, this purple line here, lives inside this order block. So it's a confluence of signals. It's a close under the 250, close over the 250 when that 250 lives inside the order block. So that is why I took the trade. So I entered here on the 11th of May at $509. I position sized. I placed my emergency stop 2 ATRs below, as always, worst case scenario. My end of bar stop is simply a close under the 250. As you can see, my entry is above the 250, obviously, but it's very close to the 250. So if the next day it closed below the 250, I simply get out, right? That's my line in the sand. That's my end of bar stop. And thankfully it held that. So close under, close over the 250 inside the order block. I entered at 509, placed my emergency stop 2 ATRs below. My end of bar stop is a close below the 250. Soon as I enter, I also place my trailing stop level 1.5 ATRs above, and here we go. Next day, took off, grateful for that, and hit a profit target right off the bat. Then we had a few days of sideways motion, no profit targets. Next day, moved up. Nice move up on that day. Took advantage of that move in my direction, sold some shares into that strength. We moved sideways for a few days. Here we move up, took some profit targets there, or a profit target there. Couple days, didn't do much. Here on the 28th, we finally got to trailing stop mode, plus a profit target, plus an intraday profit target. Now, again, I'm in trailing stop mode. It doesn't mean I do anything. It just means now I am in trailing stop mode. And the very next day, after being in trailing stop mode, we have a close below a previous bar's low after hitting trailing stop level. What are my rules telling me to do? Sell half of the shares that I have remaining. And I did that for a gain of 3.57%. Lock that in. Next day, we moved down. Okay. Next day, we tested the 250 again. It tested it during the day and closed above it. This is a bounce. Had it closed below the 250, that's the end of my trade, right? But it held the next day, moved up nicely, hit a profit target into that strength, reversed back down. I thought, oh, this may be the day that I have to get out of this trade. But it held 250, which kept me in the trade. Next day, up again, profit target. Next day, up again, profit target. Next day, down. Next day, up, profit target. Next day, profit target at the open, reverse back up. Thursday, huge move up, many profit targets into that strength, and then Friday down a little bit. So this has been a nice trade. The remaining shares I have on this particular trade are up, looks like 5.8%. So again, a very good example of having a good risk to reward ratio, starting risk to reward ratio with a rejection of a major moving average inside an order block and having that good risk to reward ratio. So been a really nice trade so far. Remaining shares again up 5.8%. Okay, silver. I've been in this trade for seems like 500 years. But I'll explain to you why that is the case. So this particular trade is down, but I'm still in the trade based upon my rules. And I entered this trade a long time ago. I entered it on February 18th here at $69.80. So there are certain trades that I take. So I just talked about getting in trades, trailing stop levels, taking partial profits, all this. 90% of all the trades that I take, this is the process that I use. But there is one particular strategy that I use where I don't do anything. I basically set a 2 ATR stop and I set a 4 ATR profit target and I just let it run. Okay, and this is one of those trades. So this trade is a combination of an order block. You can see this thin little green order block. This is an order block But then you see this highlighted blue bar. This highlighted blue bar is what is called a bullish abandoned baby. Strange name, I know, but let me explain why it's an abandoned baby. So abandoned baby consists of three bars. Bar one, bar two. Bar two gaps below bar one's close. So you can see from bar one's close to the open of the next day, we gapped down. Okay, this is bearish sentiment. However, the very next day, we gap up. And when you have a very sudden change in sentiment from bearish to bullish, long term, that's generally a good sign. So, two things happened here. We have the abandoned baby, and we also reject the order block. The previous day we were in the order block. The next day we closed above the order block. That's a rejection at the top of the order block. So on this particular trade, that's why I took that trade. Now, when I use an abandoned baby or I use an island reversal is the same as an abandoned baby. It just consists of more than one bar. The baby's one bar, island reversal could be two or more bars. So on this particular trade, because I like to have a little diversification in the way that I manage trades, I make it very simple. So I entered here 69.80. I placed my emergency stop 2 ATRs below. So if it hits that, I lose 1% of my account. To the upside, I place a 4 ATR profit target. So I am willing to risk 2 ATRs to make 4 ATRs. I just had a trade last week that I got out of, exact same kind of trade. I risked 2 ATRs to make 4 ATRs, and I hit the 4 ATRs, right? So I made twice as much as I'm risking. So, but this trade, I haven't hit either, so I'm still in the trade. So I entered here, placed my emergency stop here, 54.90, placed my profit target 4 ATRs above. You can see the trade started off great, down, up again, down, all over the place. And you can see last week, I got very close to my 2 ATR stop. Has not hit it yet. If it hits it, I'll just get out. I was wrong on the trade. We've rallied a little bit the last couple days. So this particular trade, not doing so hot, down 13.98%. But remember, if I hit my if I hit my emergency stop, the way when I got into the trade and position sized it, how much would I lose on the trade of my account? 1%, right? So I've probably lost about 0.6%, although the percentages from my entry are down 13.98%. So as long as it stays above 54.90, I'm staying in the trade because that's my trade plan. And if it hits it, I'll just get out. Otherwise, I'll just stay in this and maybe it'll move back up. Who knows? We'll see what happens, but I need to follow my plan. So this one down 13.98%. UNP. All right, UNP's been a good trade. This is what's called a higher low V1 in the value zone. If I can bring your attention to this green line, the bottom green line, and the top green line, anywhere below the top green line, anywhere above the bottom green line is considered the value zone. This is an important level here. I always buy under value and very likely sell at value, or I can buy in value and sell above value, just as a general rule. But what I don't want to do is buy above value. A lot of retail traders, beginning traders, they buy above value, and then when it comes back to value, they generally get out of the trade. It's, in my opinion, the opposite. We want to buy something in value, sell it above value. Buy something below value, sell it in value. So on this particular trade, I entered this trade here on the 4th of June because prior to that, we were below the value zone. We were below the value zone. That's the first requirement, being below the value zone. The second requirement is we have to rally back in the value zone. The third requirement, after rallying back into the value zone, we need to have a pullback and a V1 or a V2 entry. A V1 or V2 entry, if you'd like to learn more about these, I have a video on YouTube about this, but I use V1s and V2s a lot in my trading, a lot. They complement any trading strategy, but essentially in this case, a V1 consists of two bars, bar 1 and bar 2. The rule is bar 2 has to go below bar 1's low and then close above bar 1's close, which this did. So that is a V1. So we were below the value zone. We came back in the value zone. We pulled back. In this case, we created a V1. I entered here on the completion of the V1 at 263.90. I position sized. Of course, I placed my emergency stop 2 ATRs below as always. Now, with your end of bar stop on a V1, your end of bar stop on a V1 is a close below the number 2 bar. We call the number 2 bar the washout bar. We call it the washout bar because it goes below or washes out bar 1. So really the reason that I took this trade is that the higher low V1 was formed. I got in 263.90. You can see I basically got in halfway of this bar. I got in right at my stop. If you take the low of the bar and the high of the bar, halfway is right where I entered. So the thought was, okay, this is a legitimate higher low V1 in the value zone. The very next day, if it basically closed below my entry at all, I'm completely out of the trade. That's it. So I basically entered my trade right at my end of bar stop. About the best risk to reward I can get. Okay, so I entered, placed my emergency stop 2 ATRs below. End of bar stop is basically any close below my entry. Placed my 1.5 ATR trailing stop level above. And fortunately, took off nicely. Next day, took off like a rocket ship. Took multiple profit targets into that strength. And in addition, got to trailing stop mode. So right off the bat, I am in trailing stop mode the very next day, which is fantastic. Next day, down a little, no profit targets. Next day, up a little. Next day here on the 10th, we have our first close below a previous bar's low after reaching trailing stop level. What do I have to do? I have to take off half of the shares that I have. And I did lock in a gain on half of the shares of 1.21%. Next day up a little bit. Friday up nicely. Now remember, I only have half the shares left, but that's okay. At least I have half. And so the remaining shares that I have on UMP at the moment, up 3.2% based upon this higher low V1 in the value zone, up 3.2%. So far, it's been a really good trade and a good example of having a very good starting risk to reward ratio. Again, if it had closed 1 penny below, basically, I was out of the trade. Speaking of higher low V1s, I took a trade on Pepsi on Friday. So I just barely entered this trade. But it's exactly what I just showed you on UMP. Look, here's the value zone, the green bar, the green bar. We were below the value zone. We came into the value zone. We had a pullback on Friday and a reversal back up. In other words, we had a V1, 2 bars, bar 1, bar 2. Bar 2 goes below bar 1's low, closed above bar 1's close. Higher low V1 in the value zone. In addition to that, it also rejected the bottom of this previous order block. See that? So a lot of things going on there. So I took the trade here near the end of the day, 144.01. Rallied actually after I bought that. I placed my emergency stop 2 ATRs below. My end of bar stop on a V1 is halfway of the washout bar. The high, the low, this red line here is halfway of that bar. So that is my end of bar stop going forward. On Monday, if it closes below this level of 143.20, that's it. I'm done with the trade. If it holds above, I'm staying in. If it moves up, I'll take profit targets. If it gets to trailing stop mode up here, I'll go into trailing stop mode. So interesting trade, higher low V1 in the value zone by itself, completely legitimate, but cherry on top of this trade is that we also rejected the bottom of the order block. And so this trade is up slightly, up 2.4%. but just entered that on Friday. All right, so those are the current open positions that I have. Now let's get into the closed daily positions that I have. So this just in general, most of the trades that I'm still in are going to be positive. The silver trade is not, but that's a little different approach. But the whole point here is if you're right, stay in the trade. You have to have a process to tell you what to do. But in general, if you're right, you're going to be in the trade. If you're wrong, you got to get out of the trade. You need to be very patient with your winners and you need to be very impatient with your losers. So when I get to the section of the trades that I got out of, they're usually losing trades or they're winning trades that hit kind of extreme levels that I got out of. So look, I'm in 5 trades, open trades. I closed 4 trades. Okay, so listen, you're going to be wrong in trading a lot, but don't take it personally. The key is if you're structuring the trade to be wrong and be wrong small, being wrong small is fine. Yeah, it would be nice to be 100% on every single trade, but it's just not realistic. It just doesn't happen. Really the best that a trader's hoping for is they're they're let's say they're going to be right on 50% of the trades and be wrong on 50% of the trades. That's totally fine. You can totally make money as long as the 50% that you're in have large wins and the 50% that you lose have small losses. So that's the case. I take losses all the time, but they're usually very small just based upon the way that I structure the trade. So let's get into Netflix. All right. So I entered Netflix here on the 9th of June at 81.40. Why? Well, we have a megaphone trend line. We have a third touch of a megaphone trend line, and we bounced right at the 30 RSI. So the 30 RSI is a key level. It bounced at the 30 RSI. It also bounced at this megaphone trend line. That was my entry. So I entered here on the 9th at 81.40. I set up the trade as normal. I position size basically based upon the current market volatility and my account size. I place my emergency stop 2 ATRs below, my end of bar stop close 1.5 ATRs above. The next day went up, did hit a profit target, thankfully, took a little off before it reversed, but held above the 30 RSI, so I kept the trade. The next day down, but it also did close above the 30 RSI. And Friday, I had to exit the trade. Why? Well, let's look at the RSI, 29.02. It closed below the 30 RSI. It invalidated the signal that got me into the trade in the first time. So on this particular trade, I just had to get out for a loss of 1.39. Okay, small loss, not a big deal. Key is when later in the podcast, when we get into potential new trades for next week, Netflix is one of them. Because on Monday or next week, if we close back above the 30 RSI again, by default, we'll probably close back above that megaphone trend line, and that would be a new signal. So look, you can always get back into a trade. You know, I think people have a tough time sometimes. They don't want to get out of the trade because they feel like, oh, I'm going to get out and then it's going to rally. Well, that's okay. Getting out is fine because you can always get back in if you get another valid signal. And on Monday, could have another valid signal. So when we get into the trades for next week, I'll go over that again. But I did get out of this trade. It was a good entry point. I configured it, structured it correctly, but it just didn't work. Took a loss of 1.39%. DoorDash. All right. So I took DoorDash here on the 14th of May at 153.70. Why? Well, you see the order block, you see the green box involved. Now, you can look at this and say, Greg, I didn't see a rejection of the bottom of the order block. I didn't see a rejection of the high of the order block, which is true. I don't see a rejection of a major moving average, so why did you enter the trade? It's true. There are times where I put in my own custom level inside an order block. And that custom level was here at 150, 140, this green line. So we have to go back into the past and see why I picked that level. Well, I picked that level based upon halfway of this number 2 bar. This is a V2. We talked about V1s, but there's also something called a V2. A V2 consists of 3 bars, bar 1, bar 2, bar 3. Bar 2 goes under bar 1's low, and then bar 3 closes above bar 1's close. This is a V2. Now, whether it's a V1 or a V2, the key level of support is always halfway of the number 2 bar. And so that is why I put in my own custom level at the 151, 150, 140 level, because it's halfway of this V2. So I moved this level into the future. And the reason I took the trade here on the 14th of May at 153.70 was because the previous day we closed under that key level, the custom level, and the next day we closed back over. So I entered 153.70. I placed my emergency stop 2 ATRs below. I placed my trailing stop level 1.5 ATRs above. Here we go. Next day, moved up into strength, took a profit target. Next day, moved up again, sold into that strength. That's the offensive part. Next day, down. Next day, that was kind of scary, went way down and then actually ended up, took a profit on target on that day. Next day, down a little. Next day, up. While it was at its high during the day, not only did I take a profit target into that strength, I also got to my trailing stop level. Next day, we have our first close below a previous bar's low after reaching trailing stop level. What did I have to do? I had to take off half of my shares for a gain of 0.18%. Next day up, sold into that strength. Next day nothing. Next day up, sold into that strength. Next day up, sold into that strength. Next day down, down. Next day up, sold into that strength. Down, down. Next day here, hit multiple profits into that strength while I had it, thankfully. And then here on the 10th, it finally closed below that custom level of 150, 140. So on the remaining shares, I took a loss of 1.81%. But here's the key. I still made money on that trade. Why? Because every time I had strength, I took advantage of it and sold into that strength. Went into trailing stop mode, took off half at a profitable level. So I'm such a huge proponent of doing this. The only time you really kick yourself is if it just trends up straight up. But usually the market doesn't just go straight up, or individual stocks don't just go straight up. Most of the time they're up and down and around. And that's why I like to take profits when I have them, because if the market ultimately goes down, it mitigates that loss. And this is an example of a trade that the remaining shares I had a loss on, but overall I was profitable on the trade. Make sense? But again, I got out here because it closed below my end of bar stop and I had to get out for a loss of 1.81%. ET. All right. I entered this trade here on the 1st of June at 1927. Why? We have an order block. Now, most of the time when I talk about major moving averages inside the order block, I'm talking about the 300, 250, or 200. But really, any moving average is allowed, because the nice thing about the moving average is, for one, they're a level of support, and number two, they give you a very well-defined line in the sand. So the previous day before I entered the trade, it closed below the 50-day moving average, the gray line. I took the trade the next day Why? Because it closed over the 50. So we had to close under the 50, over the 50. I entered 1927. I placed my emergency stop 2 ATRs below. My end of bar stop is simply a close below this 50. And you can see how close I entered the 50 when I entered the trade. So right off the bat, it's a good risk to reward ratio. I placed my 1.5 ATR trailing stop below above. Next day, great, took off. Thankfully, because it ended up going down, I sold into that strength, locked in a little profit, and more importantly, if it turns into a loss, which it did, the loss is mitigated because I have fewer shares. So next day, moved up nicely. Next day, up again, profit target. Reverse back down, down, down. And then on this day, it lost the 50 on a closing basis. It closed below the 50. So what did I have to do? I had to get out of the trade and take a loss on the trade for a loss of 1.65%. Now, next day, continue down. We reverse back up on Friday. But again, just trying to make the point of why, in my opinion, it's so important to take partial profits when you have them, because in this case, taking the partial profits here and the partial profits here locked in some gain, but more importantly, reduced my position size, because when the trade ended up as a loss, it mitigates the loss. Okay, it's all about trying to mitigate loss. So this trade I got out because it lost the 50-day moving average. It invalidated my trade to say, I got into this trade saying, okay, the support's going to be the 50. It closed below. It proved me wrong. I got out for a loss of 1.05%. All right, last one, Microsoft. Microsoft just come down so far. But I took the trade here on the 8th of June at 411.51. Why? We have this tiny little green order block, and then inside the order block, we have the red line. The red line is the 100-day moving average. Remember, I can use any moving average. Well, on this particular day, it bounced at the 100-day moving average. So it stayed above the 100-day moving average inside the order block. So I entered 411.51. I position size. I placed my emergency stop 2 ATRs below. And more importantly, my end of bar stop is any close below the 100. Well, the very next day it happened. I locked in a loss of 1.85%. But more importantly, had I not adhered to my rules and locked in, look, down, down, up a little on Friday. So listen, I wish every trade was going to be a positive trade, but it's just not. All you can do is be patient, wait for a rejection of a key level, position size based upon the volatility. And if you lose that level, just get out. It's not personal. The market just didn't agree with you. But the more important part is if you are right, you can have a big potential outsized gain. If you're wrong, you just get out for a small loss. You are going to have some big gains in the future for sure. And you're going to have a lot of losing trades for sure. But the losing trades, if you structure it correctly, will be small. And big picture, those handful of big gains you have are going to pay for all your little losses and hopefully more. So you're taking your losses is the expense of your business. The revenue are your winning trades. You always want to keep in business, you want to keep your expenses low and your revenue high. It's the same thing in trading. Every business has expenses. Every trader is going to take losses, but you're just trying to mitigate those as much as possible. So loss of 1.85% on this trade. All right, lastly, I also trade the weekly bars. The trades I just showed you were all daily bar trades. Weekly bars here, McDonald's. So every single bar here is an entire week. So I really like this setup. I got into this trade on the 15th of May at 276.19. Why? Well, we had the 200-week moving average inside the order block from the past. We rejected it, closed above the moving average. I entered here 276.39. I placed my emergency stop 2 ATRs below. I placed my trailing stop level 1.5 ATRs above, and my end of bar stop is simply a weekly close below the 200-day moving, or 200-week moving average, excuse me. Next week, moved up, great, hit a profit target. Next week, down. Next week, during the week we were down, but reversed back up, closed back up, kept me in the trade. This week up nicely, actually hit a profit target as well. So I'm not to trailing stop level. Oh, and by the way, also got a $1.86 dividend on that as well. So you have to add that in there. So far, this particular trade up 2.88% plus the dividend I got as well. I can't figure those numbers, but additional because it's got the dividend as well. So it's a good example of being patient, waiting for a rejection of a confluence of signals. The confluence of signals was a rejection of the major moving average inside an order block. I don't have any control over this. The only control I have is if it closes under, I got to get out. If it stays above, I'm going to stay in. If it continues up, I'm going to continue to take partial profits. If it gets to trailing stop level, I'm going to go into trailing stop mode, and so forth and so on. But good little weekly trade here, up 2.88%. All right, listen, before we take a look at the potential trades for next week, let's spend a few minutes and let's talk about trading psychology. Always, like I said, the most important part, in my opinion, in trading is the psychological part. And I always find uh, some posts online that try to make my point or some good information on a trading psychology standpoint. And let's talk about this. Okay, this post is from Julian Komar. Julian has a really great channel, always posts many good things about trading. You can follow him at blog Julian Komar over on Twitter X. And I've highlighted this post before. Actually, Julian is highlighting some things that Mark Minervini, one of the market wizards, has said. And, these are so good, so relevant. And so just want to go over each one of these. A few key decisions early in my trading career and my financial life completely changed for the better in just a few years. So these five are kind of some principles, tenets of Mark Minervini's trading. And I would imagine all of us would like to trade like Mark Minervini. So let's see what he has to say. First one, no big losses, 100%. Number one, you know, big wins are fine. Small wins are fine. Break even wins are fine. Small losses, fine. Just part of trading, just the expense part of your business. But the key is structuring your trade to avoid big losses. And the way we do that, the way that I do that, emergency stop. Worst case scenario, 1%. That's it. So number one, no big losses. Number two, no averaging down. It's true. The old saying, losers average losers. When I get into a trade, I'm just going to take the trade. If I know, like it's human nature to want to average down because, oh, well, now I've reduced my average price. I'll just keep doing that. It has to bounce, right? Doesn't have to bounce. A lot of times it will bounce, but there are times where it will just continue to go down and down and down and down and down, and then you're screwed. So no averaging down on losers. Number three, no chasing extended stocks. This is hugely important, everybody. In my trading, there are no go areas for me to buy anywhere above the 1 ATR channel, anywhere above value. I just don't buy things that are above value. And I see many beginning traders, retail traders, they're always buying near the top. They're buying extended, right? So no chasing extended stocks. There's areas on the chart I'm just not going to buy. They may continue to go up 100%. It's happened a million times. But there's certain areas for me, at least in my trading, where I'm willing to buy a stock and certain areas where I'm not willing to buy the stock. And By doing that, it keeps me away from chasing extended stocks. Number 4, no giving back decent profits. 100%. A lot of traders have a nice profit in a trade and they just give it back. That's why in my process, I go into trailing stop mode. I sell half. If you have a close below previous bar's low, I'm taking profits into the strength, right? This this all has to do with me not wanting to give back decent profits. And number 5, always get odds on my money. What does that mean? Well, a couple things. Let's start with the signal that you're entering. If I wait for a confluence or a combination of signals happening at the same time, just by that fact alone, I'm getting odds on my money because I have an edge in that entry. In other words, I know if I have this certain pattern, more times than not, it's going to go in my direction. Not all the time, but more times than not, it will go in my direction. That's getting odds on your money. The other way to get odds on the money is having a good risk to reward ratio. Remember, I told you I like to buy as close to my entry, as close to my end of bar stop as possible, because that gives me odds on my money. Because if I'm wrong, I can be wrong small. If I'm right, I can have a potential for a big gain. That's also getting odds on your money. So having the correct setup that has a winning edge in it is one, and then number 2, having that definitive line in the sand where if I'm above this level, I'm staying in. If I'm below this level, I am getting out. So anyway, just a quick review. No big losses, no averaging down, no chasing extended stocks, no giving back decent profits, and number 5, always get odds on my money. And really, what this comes down to, well, let me ask you this. When you, in your trading, does your process account for all of these things? If it doesn't, you got to get a process that takes into consideration all of these things. It comes down to having a good trading process that factors in all of these. But then, as always, you can have the best rules in the world, but if you don't follow them, it's not going to work for you. So get yourself a good process. More importantly, follow. All right. So let's talk about the trades for next week that I'm looking at. Here I have 9 potential trades for next week. Now they're not where they need to be yet, but they're within striking distance. Now, I'm going to go over all 9 of these with you, talk about what I'm looking for. It is a potential next week that all 9 of these signals could happen on the same day. I mean, it is possible. But if that happens, I'm not going to take all 9. As a matter of fact, I have a rule where I only take 1 trade per day, per time frame. Even if all 9 of these trigger, I'm still going to have to find the one out of the 9 that's the best. And so how do I do that? Well, really, whenever I have a potential entry, especially if I have multiple entries on the same, or potential legitimate multiple entry trades on the same day, I have to whittle it down to the very best one. And so how do I do that? I give every signal or every setup a quality score. Just very basically, if it has 1 signal, I give it 1 point. If it has 2 signals, I give it 2 points. I'm probably going to take the one that has 2 points instead of 1 point. But there's other things to think about too. I could have a signal that gave me 5 signals, but it has a horrible risk to reward ratio. So I've got to back some points out of that. I also look at higher time frames. If I'm trading the daily, I can look to the weekly, see if the weekly has some kind of setup or rejection of level on the weekly. That could be the tiebreaker between this stock and the other stock, because on the daily they look exactly the same, but on the weekly one looks better than the other. I also look at relative strength. In other words, if the market's down, but one particular stock is up on a down day, well, it's stronger than the market that day. It gets an extra bonus point for that. All right. So that's what I do. That's how I trade. That's how I teach. And if I could just take a minute or two to put in my own little plug for today's podcast. I do teach private one-on-one lessons. I teach people all over the world. I teach a 20-hour course, one-on-one course. I think it's very important when you learn something to learn it one-on-one with your instructor or your coach. I teach you all the different trading strategies that I use. I teach you all the rules. We meet 2 hours a week online for 10 weeks, so we'll be spending a lot of time together. We'll look at a lot of different market conditions, but I teach you all the strategies, all the rules. We do a lot of simulation trading, so I can make sure you are understanding and retaining what I am teaching you. I've been teaching for years and years and years. I teach people from absolute beginners all the way up to the hedge fund level and everywhere in between. And I would love to have you as a student. I will teach you everything I know. You will learn a skill that you can use the rest of your life. The course does cost $2,000 for the 20 hours, but it's worth every penny. You're really going to learn a skill. So if you'd like to be my student, please send me an email. The email is in the link. If you do, send me an email and say, Greg, interested in taking your course. I'll reply back and say, hey, that's great. Thank you so much. What do you think about doing a kind of an introduction call? I promise you it's not a sales call at all. I just want to learn more about my potential student, their trading goals, their trading challenges. It's a good time for the potential student to ask me any questions, but not a sales call at all, everybody. Just want you to know that. Just kind of get to know you call, see if we're a good fit for a student as a teacher. But I'd love to have you as a student. Please email me and we get the process started that way. If you like online courses, I have a really good online course available at udemy.com where I teach you step-by-step the deep dip buy stock trading strategy. It's 9.5 hours. I think it's very reasonable. It's between $30 and $50. And so that's a good place to start too. But whether the online deep dip buy course or the one-on-one course with me for 20 hours, love to have a student. I'll teach you everything I know, and the links for both of those are in the description. So anyway, thanks for letting me put in my little plug, and let's get back to business. Okay, so like I mentioned, we have 9 potentials for next week. So let's start with Apple. So Apple had this tremendous run up and really underperforming the market in the last, week and a half, 2 weeks. But we are coming into some kind of important levels. We have an order block here, back here on the 4th of May. And as I mentioned, in order blocks, I'm looking for major moving averages, rejection of the high or the low of the order block, but sometimes I put in my own customized level, and that's what I did on Apple. I put in a customized level at 277.40, and let's just review why. Well, look, here's a V2, bar 1, bar 2, bar 3. 2 goes under bar 1's low, 3 closes above bar 1's close. Where's the inherent support level? On the number 2 bar, halfway to 77.40. So if and only if maybe Apple takes off from here and I don't have the trade, that's fine. Eventually something will get to where I want it to get to. But this is the level that I'm looking for right now. 277.40, a rejection of that level. And if it rejects that level, I'll consider taking the trade. My end of bar stop will be a close back below that level. So I always start with a good risk to reward ratio. So that's what I'm waiting for. Also, a rejection at the bottom of the order block would also be valid at 274.51 as well. Okay, the next one is Amazon. Amazon has really been having a drawdown here, but we are getting to some important levels here. We have the 200-day moving average, we have the 250, we have the 300. These are all deep dip buy levels. I don't have an order block, uh, uh, but we are also at a very low RSI at the moment too. We're at a 34.73 RSI. One of the best combinations of entries is when you have a combination of a rejection of a major moving average like the 200, 250, 300, at the same time, you have a rejection of the 30 RSI level. And so we are getting close to these levels. In addition to that, we have this megaphone trend line. A megaphone trend line is when you connect a swing low to a lower swing low, connect these points, the trend line will go out into the distance. Generally, not always, but generally, when you have a megaphone trend line, if the price then in the future rejects that third point, this is the first point, this is the second point, a rejection here of this trend line in the future would be the third point. That by itself is a strong signal that you're oversold and you're going to bounce. But in this particular case, you can see this megaphone trend line dovetails with major moving averages and the low 30 RSI levels. So really, ideally at this point, I think depending how soon Microsoft goes down, or if it does, it might just take off. But 30 RSI levels probably going to happen right about in this area where the trend line is. And like I mentioned, in addition to that, you have the major moving averages. So I can't say exactly what this is going to look like, but a rejection, even a rejection of the 200-day moving average would be legit. On my charts, we haven't quite got to the 200 yet, but I'm going to be looking for the following: a rejection of the 200, that's 232.51 at the moment, a rejection of the 250, 250's at 230.62, or of course the 300-day moving average down here at 224.63. But there's a lot of stuff going on basically in about this area here. So if it comes down, continues to come down next week, and we get into this kind of area here, in my opinion, there will be some kind of support here. If the price action reflects it and rejects one of these levels, it could just get here. Doesn't mean I would buy it. I want it to reject something. 200, 250, 300, 30 RSI, or the megaphone trend line, and they're all kind of here in the same area. So I'm going to be watching Amazon closely. Walt Disney. All right. Well, Walt Disney, we have a new order block. Swing low, swing high, lower swing low, market structure change. Defines the lowest closing bar prior to market structure change. Now, there's quite a few levels inside of this. Friday already we rejected the high of the order block. So technically that would have been a legitimate signal. I didn't take it because I don't usually take rejection high of the order block, but we have two custom levels. The first level here is at 99.30. Why 99.30? Because this bar here, you see the big up bar? Whenever you have a big upsized bar larger than 1 ATR, that always stands out to me because I know from a Fibonacci standpoint, the halfway of that up bar, there will be some important support, inherent support. And so I drew the custom line in at 99.30. A rejection of 99.30 would potentially be an entry for me. My stop would then be a close back below 99.30. We have another custom level here at 98.79. What is this one? Halfway of the washout bar, the V2. Bar 1, 2, 3. 2 goes below bar 1's low. Bar 3 closes above bar 1's close. The inherent support is at halfway of that, 98.79. So at the moment, I'm looking at two main levels and a third level too. The first level would be a rejection of 99.30. The second would be a rejection of 98.79. And if either of those trigger and I take them, I would use those levels as my end of bar stop. And then, of course, the bottom of the order block is always going to be legitimate as well. The bottom of the order block is 97.95. Meta. So Meta hasn't been doing so hot tamale for sure. And they're starting to get into some key oversold levels. So I'm going to take you back to here, 327. On 327, we have what is called a bullish island reversal. Let me highlight these guys in blue here. An island reversal happens when you have a gap down and then you have a sideways motion, and then you have a gap up. Okay, that was a key signal right there. Again, it's the bearish, the gap down, the bearishness, the sideways, and then the immediate reversal back up. So the very sudden shift in sentiment from bearish to bullish. So it left these two bars down here. That's called the island reversal. And you can see that signal was very strong. Well, here's the thing, everybody. When you have an island reversal, the high of that island reversal is generally a very strong support level. And you can see we are coming back down to that level. This island reversal is also an order block. So I'll tell you really what I'm looking for. I am looking for a rejection of the high of this island reversal, which is 543.60. If that happens and it rejects that level next week, I will definitely consider taking the trade because it's an island reversal. If it rejects that, the way that I'll manage this trade is I will put a 2 ATR stop below and a 4 ATR profit target, one or the other. It's eventually going to, I'm eventually going to lose 1% of my account, or I'm going to make 2% of my account. But this is very interesting trade. Obviously, Meta has sold off significantly, but it is coming down some important levels. And that level for me, rejection 543.60. And if that happens, I'll consider taking the trade. 2 ATR stop, 4 ATR profit target. Netflix, okay. Netflix is the one that I stopped out of on Friday because we lost the 30 RSI. I took it here. Friday it lost the 30 RSI. But just because I stop out of a trade doesn't mean I cannot just get right back in the trade. And right now the RSI is 29.02. Monday or next week, if it closes back above the 30 RSI, it will also close back above this megaphone trend line. And there's two confluences of signals. Close over 30 RSI would be legitimate, but cherry on top of that, if it closes back above 30 RSI, very likely it will close back above that trend line, and that may be enough to get me into the trade. So I'm really going to be watching the 30 RSI. If we close back above, that would be my entry. Again, my stop in the future, if that happens, would be a close back below the 30 RSI, just like this trade that I took here. Rejected the 30 RSI, but Friday closed below, got out. But again, doesn't mean I can't get back in the trade with another close back above the 30 RSI. And Netflix is certainly oversold at the moment. In addition to that, everybody, we have a very significant double bottom bullish divergence. This is also something I teach in my course, but look at this low here. We have this low here. You look at the red MACD bars, they're very deep MACD bars down. What this is showing you is a very strong selling momentum. Well, clearly we are lower here than we are here, but look at the MACD bars now. They're not as deep as these bars. What this is insinuating is that the selling momentum is drying up. In other words, you're running out of sellers. And if you run out of sellers, generally you have a bounce. Don't know for sure, but in general, people always think that lows happen and we go up because a lot of buyers. Really, it's not true. What's true is that the reason you go up is you run out of sellers. And this double bottom bullish MACD divergence is showing that the selling momentum is running out. In other words, you're running out of sellers. So this as a high level context is bullish, but you still need a signal to get into the trade. And the signal for me would be a close back above the 30 RSI. The Qs, well, this was a hot mess. I was looking for, if you listen to the podcast last week, I was looking for rejection in this order block of this custom level here at $706. Well, that happened on the 9th. I didn't take that trade though, because I didn't like the risk to reward ratio. The next day we plummeted back down. And then the next Thursday, we went way back up over this level. Again, I didn't get in the trade because it wasn't a good risk to reward ratio. This closing price is very far from my level. So I just had to let it go. However, what I am looking for is if the market does pull back, I'm again looking for that same level. rejection of 706.60 cents. I don't know if it's going to get there. Don't know. But if it does and it rejects that $700.60 level with a good risk reward, I will consider taking the trade. USO oil. All right, so oil has gone down significantly based upon what's going on in the Middle East, but there are some key levels that we're not we're not really close to them yet, but if oil continues to slide down, we are getting close to some key levels. Let me first highlight Abandoned Baby in the blue. Remember Abandoned Baby? We gap down and then immediately gap up. That sudden shift in sentiment from bearish to bullish is a bullish signal. And you can see, was it correct? Certainly was. Now, if you have an Abandoned Baby, the high of that Abandoned Baby is a key level. The high of that Abandoned Baby is 116.80. We're at 125.43, so we're still significantly away from that. However, next week, if we continue to move down and reject 116.80, that would be a rejection at the top of the Abandoned Baby. If that happens, I would consider taking the trade, 2 ATR stop, 4 ATR profit target. If it doesn't reject the high of the Abandoned Baby, we have this 100-day moving average here at 114.58 inside an order block. If it doesn't reject the 116.80 but comes lower and rejects the 100-day at 114.58 at the moment, I would also consider taking that trade. If I took the trade on that day, I would use the 100-day as my stop. It would have to reject the 100 to enter the trade, and then my stop going forward, end of our stop going forward, would be a close back below that. Another level is this custom level here at 113.30. Why? Refer back here. Big up bar, halfway of a big up bar, inherent support, 113.30. So that's what I'm looking for as well. In addition, of course, the rejection of the low of the order block would be legitimate. The low of the order block is 110.34. So the levels that I'm looking at, rejection of the bottom of the order block, 110.34. Rejection of the custom level here, 113.30. Rejection of the 100-day moving average, 114.58, or a rejection of the high of the Abandoned Baby, 116.80. Basically, in this area, there's lots of potential support levels and potentials for entries. The VIX. Interesting. VIX really did almost exactly what I said it was going to do. Here on the 5th, we changed structure to the upside. We have a swing low, we have a swing high, we have a lower swing low, we changed market structure here. On this particular day, what I mentioned was if now the market is vulnerable to going down, if the market comes back into the green area, that means the market went up, but we're coming back into a smart money area. So if we get to that smart money area, very likely VIX will bounce and the market will go down. It's exactly what happened, everybody. We broke structure. The next day, VIX went down, market went up, but this is the buyable area. VIX shot up. What did the market do? It went back down. The takeaway here, everybody, is that I have a key. Okay, the thing that concerns me about the market is we are back in the bullish order block. There is a key level here at 23.95 that I'm looking at. What is that key level? Halfway of this V2, bar 1, bar 2, bar 3. 2 goes under bar 1's low, 3 closes above bar 1's close. Halfway the washout bar is the key level. So 23.95. Next week, if VIX continues down or rejects 23.95, I will certainly consider taking a long position in VIX and then using that 23.95 as my end of bar stop. Big picture, however, if VIX does get down to that level, to me, that's a danger sign. That's a red flag for the market. So please keep that in mind. But just on face value, on the VIX trade, a rejection of 23.95 is a level that I would potentially look to be getting long the VIX. And last but not least is Exxon. Okay, Exxon's in the petroleum. arena, of course, it's been weaker with the price of oil going down, but we have some key levels here on Exxon. And what I'm looking for, we're in an order block back here from 417. Really, the level that I'm looking at is this custom level 143.40. And again, why this level? Because if you look here on 417 with this huge big up bar, the inherent support on the big up bar is halfway. So if it rejects 143.40 next week, I would potentially be interested in getting long Exxon here, and my stop would be a close back below 143.40. So those are the 9 that I'm going to be following, looking at very carefully next week. Hope you found this podcast helpful, everyone. If you did, like I said, if you could hit the thumbs up button, I would appreciate that. If you have any comments or questions about anything that I went over today, please put them in the comment section. I'll do my very best to get back or answer any questions you have. I always like to leave off with, this world's kind of a crazy place. And, the old saying, as far as, if you could go out and do something nice for another person every day, if you have the opportunity, it would make the world a better place. I think we need it could be a little better place. So, why don't we let it start with us? If you have the opportunity to do something nice or helpful for another person each day, they're going to appreciate it. It's going to be good for you. All in all, just make the world a better place. I'm also a big animal lover. And, if you have the opportunity to do an act of kindness for an animal each day, they appreciated it just like we do. So it doesn't take a lot. And it's good for the animal, good for the human, good for you as well. It's kind of a win-win all around. So I really appreciate you being here, everybody. Like I said, if there's anything I can help you with in trading, I teach private one-on-one lessons. I do private consulting, have the online course available at udemy.com. So if I can help you in any way, please let me know. I appreciate you watching the podcast. I hope you found it helpful, everybody, and God willing, I will see you next week. So thanks so much. Enjoy the rest of your weekend and have a good trading week next week. Take care. Bye-bye.
U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.